Morning, everybody. I hope you're all well rested from yesterday's events and everything else that's going on. I'm going to speak to you today about capital efficiency and operational risk. I kind of mentioned yesterday in my opening keynote a little bit about what we do and why we do it. Ultimately, everybody that's here is trying to drive institutional adoption. With that, of course, come a lot of risks and problems. What we're going to do today is going to have a look into the market state right now, how it has been, how institutional adoption was driven in other asset classes that we deem as very, very normal nowadays. And we're going to look into solutions that need to be built in order to make sure that this adoption has enough legs in order to drive what we all want to see, that this asset class ultimately grows. I'm not sure of how the presentation is going to be put up here, but I've got a couple of slides for you so you don't have to constantly look at my face, which you now have two of, actually three. There we go. So before I start, let me give you a quick intro in who we are. So we started about 4 years ago. We come from traditional finance. We mainly have traditional finance backgrounds. And then, of course, there is the other arm, which is technology-driven. Towards the end of 2017, myself and also my business partner, Dimitri, we got a lot of calls in our asset management functions to go like, look, this crypto thing is happening, and we would like to get some exposure. So we were looking into this. We were looking into setting up a fund, and subsequently looked into what infrastructure we can use in order to run a fund like you're very much used to in the traditional world. And it was underwhelming, to say the least. So subsequently, we took the decision to start with the core problem in the industry, at least at that time, which was custody. It was solved by a couple, of course, already. BitGo was early in the game. Zapo, which was taking an approach of having, a Swiss mountain with dogs and guns and guards. It's a little bit of an approach for anything actively traded where you don't really have an access to your funds the way that you want them. Now, with that, of course, we had to look into how the industry is going to hopefully evolve. What we've seen over the course of the last 4 or 5 years especially, is that we saw institutions coming in. Now, when I say institutions, you have to make a distinction between what kind of institutions we're looking at. And if you look at the names that you see on this list here, you see mainly corporate treasurers. Corporations were the first ones to kind of understand, okay, hold on. And if you see the names, of course, you also see they're quite cash rich. So ultimately, they were figuring out where to put their money and bought into the idea early on. Tesla, Elon, and we can all agree that Elon has done good things for Bitcoin and unfortunately also for Dogecoin. And subsequently, of course, also did bad things with his tweets, but that ultimately will not be holding up going forward, and I'm going to go into the reasons why. BNY Mellon announced that they're going to start getting into the custody space. You have, on the other side, Bank of America. A lot of the traditional big players are looking into how they can participate in this asset class, because the agreement, like Jamie Dimon did a 180-degree turn, as we all know. So those companies here, PayPal has bought Curve. You guys potentially have seen that as well. So ultimately what it comes down to is the fact of like, when do bigger institutions, bigger players get into the space, and what does that ultimately do to the space at all? And I mean, the numbers are speaking for itself. Early investors in this space, you guys are very happy, of course, by now, even though Charlie says that it's overpriced, but that's a debatable statement. Now, if you look at the market and you change that to the traditional world that we all know, equities, fixed income products, all those, I just kind of took an extract here from the equities market. I mean, the equities market nowadays has about a global market cap of around 110, 120 trillion. The US equities are sitting at around 46 to 47 trillion. And since 1940, you basically see how the split has changed between retail and institutions. In the early days, of course, there was a lot of paperwork. On the exchanges, you had pits with people screaming with paper in their hand until somebody said electronic trading might be a little bit more efficient. And those paradigm shifts have happened throughout the evolution of the financial market in any shape or form. Now, if you take the speed at which the digital asset space is moving, you can mathematically have a look at this over the course of the data that we have since 2010, especially since 2017, you basically can put a factor of 4 on it, which ultimately kind of will derive on the fact that we will definitely grow in this space much faster than we've done in the equities market. And subsequently, we will see, of course, a adoption rate over the course of the next 10 years, which should and will ultimately end up with institutions being the driving force in this space. When I say the driving forces, the reason for that ultimately is what we live in every day. We're much more connected. I said yesterday, if you look on Bloomberg, if you look on CNBC, Bitcoin is everywhere. It's in the newspapers, social media, etc. People are slowly starting to agree to the fact, and that's the wider public, that this asset class is one in its own right. Now, debatable is the fact, well, are we talking about Bitcoin? Are we talking about Ethereum, Solana, Cardano? Are those going to be the ones that are going to be the way that you see them right now in the markets traded with its utility and use cases? The use cases are going to be very, very important when it comes to the tokenization piece. And the tokenization piece is going to be the one that is going to drive this industry forward. We are living in a world, in the traditional finance world, and I'm sure most of you have worked in that industry, where you've got somebody on the 3rd floor punching in a trade on a Wednesday, and on a Friday you still have the back office running around chasing empty 500 messages in order to settle the trade. Not necessary. Those is built very, very much legacy driven and ultimately inefficient. Which kind of brings you to the point of like, what does this industry actually do for us? What does this space do for us? What does the asset class do for us? And there are several points here. On the one side, of course, you've got the operational risk. There have been funds out there, which you have seen in the press. Fraud has been a point. You still have people nowadays going around and saying, like, everything's a fraud. It's a scam. We can all agree that that's not the case. Key management practices are absolutely important. Ultimately, where are the assets held? How are they being secured? That's why the custody piece is so crucial. On the other side, of course, you've got the counterparty risk, and that is inherently very, very existent. The industry has been built by tech players, and tech players are extremely important in order to drive innovation. But ultimately, it comes to the fact of like, how are you integrating and how are you cooperating with a industry that is built on segregation of duties, which is going to be one of the key topics of one of the products that we have built over the course of the last year and a half, which is a product called Clearloop, and I'm going to go into quite some depth there in order to kind of reduce counterparty risk when it comes to interacting with exchanges, when it comes to reducing counterparty risk even when interoperating with a custodian. And so on and so on and so on. Fragmented and evolving landscape. The ability for you to connect multiple protocols. We're talking about DeFi. We're talking about interchain operability, which is interesting. And all of those topics need to be addressed from a security perspective, which ultimately can only be done from an infrastructural angle. Now, what does the long-term vision look like? And we've heard about this now over the course of yesterday and also today, and we will hear more about this. The way that traditional finance is built, reconciliation is an issue. Like I said, the settlement part is a problem, T+2, T+3. You have the beauty of the technology itself, which is going to be the key use case that is going to drive this forward. With immutable records that are stored forever. And then, of course, the programmability. But ultimately, the very, very important point is the last one, the optionality in order to create new assets, new types, more liquidity. You have banks that are sitting on illiquid assets, and because of anything between Basel II to Basel IV when it comes to capital requirements, this asset class, this technology allows you to tokenize this and take this off balance sheet. That's mind-blowing to anybody who runs a big balance sheet or a big risk book in a bank, and it will enable to make things that are currently relatively liquid very, very liquid. Now, if you ask me personally, we will have to figure out the centralized, all the CeFi stuff first before we go DeFi. But smart contracts are going to be definitely the way forward, but we talk about at least a time span of about 5 to 10 years until we get to that point. But it will ultimately mean that you potentially are sitting at the airport and you bought your ticket and you have a smart contract that is linked up between the delay of your plane, and while you sit there, have your coffee, there is money coming into your account instantaneously because you've got an insurance contract on it. Things like this. And you can spin this extremely, you can go extremely deep into that rabbit hole. Ultimately, it comes back down to infrastructure. And the infrastructure piece that we have built is mainly built for, or it was originally built for actively traded strategies. Managers that are trying to raise capital from LPs and subsequently manage that across various venues with all sorts of strategies. Market neutral ARB is still a thing, but you can go into any sort of multi-strats that are running across various venues. And you encounter a lot of risk and a lot of problem with that. And Clearloop is one of the solutions that is built upon the custody piece, which is basically taking the operational risk side, the counterparty risk side as its core, and ultimately increases capital efficiency for the manager or any sort of corporate treasurer that also wants to trade, whatever it is. Now, 3 points here. I mean, the minimize of counterparty risk, the operational risk, and of course the increase of capital efficiency. Now, what you basically are doing, and I'm going to come to that, is that I'm actually going to go straight to the next slide. We're linking up custody with your execution piece on exchanges. That's basically it, without overcomplicating it. Which means that you have a segregation of duties between the exchange being in charge of the best possible spread, the best possible matching, the execution piece, while your assets, your collateral is sitting securely within custody, MPC-enabled custody. There is no tokenization bollocks, none of this stuff. It just sits there, and you just ping tradable balances to the venue, and subsequently trade, and post-trade there is a settlement instruction sent to a third-party custodian, in this case us, and you settle within. What does that mean? Now, in some cases, like OKEX, for example, is maybe the recent one that you have heard, well, that was last year. The DOJ walked in and said, guys, party's over, and suddenly your funds are locked for 3 months and you can't get them out. Now, that's a problem if you're running a fund. Clearloop is solving those issues from a KYC ML perspective. I don't want to bore you too much, but we do everything on that front from the outset. We're MLD5 regulated here in the UK. There is a lot of conversation that we can have around this, and regulation you heard a lot about here, and please find us afterwards and we can go into absolute depth of the weeds. But ultimately what this does is you have the ability to trade on all those venues with your capital sitting centrally. Also, that all happens off-chain, by the way, so you don't need to move anything. You save a ton of money in terms of network fees. But it does one thing, and it does one thing very, very well. It's being extremely capital efficient for you. To the extent that when you run a market-neutral arbitrage strategy across 15 venues, the problem that you have is that you will have to have debt capital sitting on those exchanges. Debt capital that you just have there in terms of the market being extremely volatile, and you run at risk of being liquidated. Because moving the funds from one venue to the other will take time. Ethereum, you might pay $1,000 and you still have to wait 5 hours later because it's not there. Ethereum, for example, Bitcoin, yeah, on average, you wait about 15 minutes, depends. There is some quicker credits that are happening between venues as well. They fetch the transaction IDs that are being broadcasted to the exchange and to the blockchain, and ultimately they credit you. But the problem still exists that you talk about minutes. But even 1 second is too long if you want to do this efficiently. Now, in this case, what you can do is you can ramp it on to one exchange, for example, Deribit. You can ramp it on, you can take it off there, ramp it on to Bitfinex. You can ramp it on to Coinflex, FTX. You potentially have seen the announcement. FTX is coming on now, and many, many others. Ultimately, what it comes down to is the fact that you, as a manager, or anybody that doesn't want to incur that counterparty risk and that operational risk, you have the ability in order to run your business on a less risk basis, but much more efficient. And that goes hand in hand with all the rest of the product suite that we have. Yield plays are massive. You have staking capabilities on the platform, just linking everything up with your secure MPC wallets. MPC stands for multi-party computation. Basically what it is, there is never a private key. There are only key fragments that are never coming together centrally. And it runs on a zero-knowledge proof protocol, but that's where we go into a little bit more of the weeds. On top of it, of course, you have OTC capabilities as well, which all leverage off the custodial bit. And this is where us as custodians in that space are now starting to work together. We need to create the network in order to be doing this just like there is in the traditional world, except that it's not based on empty messages between the venues in order to move funds from Boney to State Street. So overall, what it comes down to is that any sort of driver that we see or want to see in the space in order to get that mass adoption. On the retail side, done. But what it comes down to the fact is you also need to realize of who is ultimately driving all those big institutions. It's you and me. We've got our money there. We are being able to call up, if we're lucky enough to call up a private bank and say, like, place me that trade. But ultimately, it's our money that is sitting with those institutions. And ultimately, this is the important bit. You need to have the infrastructure in order to do this. What we're seeing right now is the big banks are moving at an insane speed. If you ask me personally, been in the industry for 15 years, finance, not crypto. Ultimately, it comes down to the fact of being surprised of how fast banks can move if they see the need in order to be part of that market and part of that asset class. Us as a business, please come and find us overall. All right. So we just, at a glance, we've got a couple of data points here, around 200 people now. We've got 400 plus clients, actually way above 15 billion. But ultimately, what it comes down to is the fact that please come and find us in order to kind of learn more. There is a lot of things happening in that space, which we're very, very happy to see. And I'm actually 3 minutes early, so I'm very happy to take a couple of questions if there are some. Anybody? Yeah.
What are your plans for kind of multi-chain DeFi kind of integrations? So your plans for multi-chain DeFi integration?
So we also have a DeFi extension. I didn't mention this. That basically hooks up your MPC wallets with all the different smart contracts. The plans are there. The problem is the current use cases, and not use cases, the current usage. DeFi is even more so retail-driven than what we see currently in the CeFi market. It's not going to be left out. That's all I can tell you. From an institutional perspective, as you will appreciate, currently it's about Bitcoin and Ethereum. You know, we're dipping our toes in. But the DeFi piece, like I said earlier, ultimately we will move towards smart contracts. I don't see this happening for the next 5 years on the institutional side. But yes, we already have that in place, so you can trade on the various, Uniswap, Compound, wherever curve. You can trade with your custody sitting at, and a lot of the managers are doing this because I mean the yields that they get on those venues is insane. And as a mix to whatever strategy you run on the multi-strat piece, it's being used already quite extensively, actually. Yes.
Over here. So
sorry.
The tokenization and the capital efficiency is really an amazing opportunity, right? That's the big one for traditional financial institutions.
Mm-hmm.
So, but in order to realize the tokenization capital benefit, you need not only to tokenize it, you need to create some liquidity in order to move it up the. So obviously you can help on the custody piece, but what are you seeing on the other pieces of the puzzle?
On the liquidity side?
Yeah.
We've already seen Santander and others, trading tokenized bonds, and they were, as expected, not only surprised but very, very happy. Yes, coming. What it basically comes down to is the fact that, I mean, we won't be doing everything. Ultimately, we are an infrastructure layer, and at core as a custodian, security is the key piece for us, and of course the ability in order to drive at least what we have right now forward. Now, on the liquidity side, it's going to be pretty strict. If you ask me that the NASDAQ or the CME is going to be the ones that are going to be driving the liquidity piece in the future, questionable. It might be SAM and FTX, or it might be Coinbase. But ultimately, this is down to regulation. This is down to liquidity is something that will be generated ultimately by the participants in the space. And as long as they grow, the liquidity will be there.